From the Streets newsroom in New York, I'm Jill Malandrino with a weekly recap and your trading week ahead. This week's special guest, Josh Van Dress of Able Capital Management. We are going to talk about the 5-day on the S&P because volatility certainly came back with a vengeance this week.
Yes, it did. So there was quite a lot of that. I think a lot of it had to do with the Draghi effect, with the $60 billion coming in. And then, of course, you had Greece, who was a little bit upset. They're threatening to default. So I think investors definitely had their volatility caps on for
And I think we're certainly going to have volatility going into the week ahead. If we take a look what's on tap, you will see that we have 22% of earnings coming out. We also have some jobs data, including JOLTS. In addition to that, we have retail sales, and also there's several large broker sell-side conferences, and that's when you get some nice intraday action because you'll get management commentary, you'll get some data from the slides, and I think that's almost more exciting trading that versus what happens pre and post market with earnings because that expectation is in there. The bulk of earnings is going to come from consumer, and everyone is focused on that. That's really been a tape of the have and have nots. Why doesn't Coke have it but Pepsi does? We'll take a look at the 1 years.
Well, I think that, you know, right now with Coke, the way that it's set up is, they're battling a lot with the overseas. I think that investors should look for where they come out with their earnings. I'm not sure how much of the currency effect they're going to have with that. I mean, 58% of their business is done overseas, and that's just in Europe. And I think another 14 or 15% is done in Asia. So then on top of that, you have the part that, you know, with the aluminum commodities, where Goldman is kind of shutting them down, so they say, and they expect literally a 13% uptick in prices just on the commodities alone. Right. Whereas Pepsi does not have that problem. So they've always hedged their aluminum prices from the beginning of time. I believe they'll continue to do that. If memory serves, I think Coke is expecting to come in with 47 cents, actually 42, which is down from the year prior, 46. And then Pepsi's coming in at 51, which is up slightly from the year prior. So I think that investors should definitely still have their volatility cap on.
Well, I also think in the consumer space as well, organic growth is the issue, and they're really growing via acquisition. We saw a couple of those this week. Let's shift gears and talk some tech, though. Jim Cramer and his team bought Cisco this week. They're expecting IT spend to be strong for 2015, and that's a very shareholder cash-friendly company. What are your thoughts?
It is. Yes, it is. It always has been. I think that Chambers has run the company extremely well. The new Nexus switch platform was a slam dunk for them. I think that for the first time, it's a pretty bold statement, but I think they might actually guide forward. You know, as an upward guidance for, you know, and it's been a long time since they've been able to do that and do it with enough confidence to promote investors to take a look at it.
Well, you see that in a lot of the legacy tech names. Let's wrap it up and talk some commodities. We'll take a look at the 5-day on energy, and that had a totally wild ride this week. We saw some pretty extreme closes. Fundamentals and technicals really haven't changed. What needs to happen before it might be time to get back in?
Unfortunately, I think that when it comes to energy, it's tied a lot with oil right now. Even though they're two separate entities, sectors, industries, everything, energy, oil, energy, oil. So I think that a lot of people, you know, with their investors' hats on, you know, they went in, they made their money for 4 days in the oil, and then boom, they got wiped out in 1 day, down 9%. So I think with the energy sector, I think it just needs to settle down for a little while, get a little bit of the volatility out of it, and just trade for the value of the company rather than a thought of the value of the company.
We've seen gold relatively range bound. You kind of have that $40 swing that it's been relatively stable to energy anyway. Non-farm payrolls came out this morning, blew it out of the water. They revised really well for November and December. Obviously, gold took a hit because interest rate hikes is now the conversation. 2015, do you think we'll see that?
No. I know that they did really well with the job report, non-farm payroll. Typically, I tend to look more towards the U6. And because of that, we're just still not seeing enough jobs data to where, in my opinion, it would merit investors' time to say, okay, let's go ahead out there and start to look at this from a point of view of actually investing instead of just putting it in a stock and hoping for the best.
Okay, thanks very much, Josh, for joining us.
Thank you.
For TheStreet in New York with your Trading Week Ahead, I'm Jill Malandrino.